December 26th, 2025, CME Group dropped advisory number 25 through 393. Starting December 29th, just 3 days later, the initial margin requirement for March 2026 silver contracts would rise to $25,000. Not a modest adjustment, not a routine tweak, a full-scale margin hike at the exact moment silver was trading near all-time highs above $59 per ounce. And if you've been following silver for any length of time, your stomach probably dropped. Because you know what this means. You've seen this movie before, twice, actually. And both times it ended the same way, violently. They're calling it a routine risk management adjustment. Market volatility, they say. Protecting market integrity. The usual bureaucratic language that sounds reasonable on the surface, but here's what nobody's saying out loud. This margin increase follows a pattern that's been deployed exactly twice in modern history. Once in 1980, once in 2011, and both times silver crashed between 30% and 80% within months. The question isn't whether this looks familiar. The question is whether what's happening right now in December 2025 is different enough to matter. Because if it's not, if this is just a replay of 1980 or 2011, then everyone holding leveraged silver positions is about to learn a very expensive lesson about how exchanges control price when things get uncomfortable. But if it is different, if the underlying physical market has fundamentally changed in ways that paper markets can't suppress anymore, then this margin hike might be the last desperate move before something breaks that can't be fixed. Let me show you exactly what happened in the past, what's happening right now, and why the next 90 days might determine whether silver explodes to 3 digits or collapses back to 30. Because this isn't about predicting the future. This is about recognizing a pattern that's played out twice before and understanding why this time the script might not work the way it's supposed to. Let's start with history. Because if you don't know what Silver Rule 7 was, you can't possibly understand what might be loading right now. January 7th, 1980. The Hunt brothers, 3 oil billionaires from Texas, had spent years accumulating physical silver and futures contracts. They held an estimated 100 million ounces or more. Roughly 1/3 of the entire world's deliverable silver supply. Silver had gone from about $6 per ounce in January 1979 to nearly $50 by January 1980. A 713% increase in 12 months. The Hunts were winning, spectacularly. Then COMEX, the exchange where silver futures traded, introduced what they called Silver Rule 7. The rule did 3 things simultaneously. First, it dramatically increased margin requirements. Traders who had been operating on 10% or 20% margin suddenly needed to post nearly 100% cash. Leverage was essentially eliminated. Second, it placed strict limits on the number of contracts any single entity could hold. The Hunts couldn't add to their positions anymore. Third, and this was the kill shot, it created what traders call a liquidation-only regime. You could close positions, you couldn't open new ones. The effect was immediate. Silver peaked at $49.45 on January 18th, 1980. By the end of March, it had collapsed to $10, an 80% decline in 10 weeks. The Hunt brothers lost over $1 billion. They were forced to pledge oil fields, ranches, and real estate holdings just to cover margin calls. They eventually declared bankruptcy. And here's the part that matters. The official story was that the Hunts were manipulating the market, cornering supply, creating systemic risk. That's probably true, but the deeper truth is simpler. When leverage gets extreme, when futures contracts vastly outnumber physical metal, when too many people are betting the same direction, exchanges change the rules. They protect themselves, they protect the system, and leverage longs get annihilated. Now fast forward to 2011, silver had been in a bull market since the 2008 financial crisis. Quantitative easing, zero interest rates, fears of currency debasement. The same macro environment that's driving metals today. Silver climbed from about $17 in 2010 to nearly $50 by April 2011. Another parabolic move, another moment where silver looked unstoppable, and once again, CME stepped in. Between April 25th and May the 2nd, 2011, the exchange raised silver margin requirements 5 times in 9 days. 5 times. 9 days. Each hike forced leveraged traders to either post more collateral or liquidate positions. Most couldn't post more. Most had to sell. Silver fell from $48 to $33, a 30% drop in a matter of weeks. The rally was over, the momentum broken. Retail investors who thought they were riding a historic breakout got crushed. 2 different decades, 2 different market environments, 2 identical outcomes. Pattern recognition matters. When margin requirements spike during parabolic rallies, leveraged positions collapse. That's not a theory, that's historical fact. So now it's December 2025, and margins just increased to $25,000 for March contracts. Is this just 1980 all over again? Is it 2011 redux? Or something fundamentally different this time? Let me show you what's actually happening beneath the surface that wasn't true in 1980 or 2011. First, physical supply is tighter than it's ever been in modern history. According to the Silver Institute, the market has been in a structural supply deficit for 5 consecutive years. That's 2021, 2022, 2023, 2024, and 2025. 5 years where global demand exceeded newly mined supply plus recycling. Cumulative deficits over that period total roughly 800 million ounces. That's nearly 1 full year of global mine production gone, consumed, not coming back. In 1980, there was no structural deficit. The hunts were artificially creating scarcity through accumulation. But supply fundamentals were fine. In 2011, there was brief tightness, but mine production was expanding. The deficit wasn't structural, it was cyclical. In 2025, it's structural. Mine production has been essentially flat at around 813 million ounces per year since 2016. Meanwhile, industrial demand keeps climbing. Solar panels, electric vehicles, data centers, defense electronics. Silver isn't just a monetary metal anymore. It's a critical industrial commodity that the US government officially classified as a strategic material in 2025. Second, COMEX inventories are under pressure in ways they weren't before. Here's a data point that should get your attention. In the first 4 trading days of December 2025, over 47 million ounces of silver were claimed for physical delivery. That's more than 60% of COMEX's total registered inventory in less than a week. Registered inventory is the metal that's actually available for delivery against futures contracts. When 60% of it gets claimed in 4 days, that's not normal market function, that's stress. COMEX total warehouse stocks have declined 73% since 2020. In 2020, there were about 346 million ounces sitting in COMEX vaults. By late 2025, the number had fallen to around 113 million ounces registered and roughly 450 million total, including eligible. Eligible silver is metal that meets COMEX standards, but isn't currently available for delivery. It's there, but it's spoken for. ETFs, private holders, banks, not freely available. When inventory drains this fast, it signals something important. Physical demand is real. Industrial users, investors, maybe even sovereign buyers are taking delivery instead of rolling contracts forward. In 1980, COMEX inventories weren't stressed. The hunts were buying futures, not draining vaults. In 2011, there was some tightness, but nothing like what's happening now. December 2025 is different. The physical market is tight in a way that's unprecedented. Third, and this might be the most important factor, there's a growing disconnect between COMEX prices and physical premiums in other markets. Shanghai silver prices have consistently traded at premiums to COMEX, sometimes $2 per ounce higher, sometimes more. That spread signals physical scarcity in the world's largest industrial silver consumer. When China, which accounts for over half of global industrial silver demand, is paying premiums, it means they can't get enough metal through normal channels. They're pulling silver out of London vaults, out of COMEX, anywhere they can find it. India is seeing similar dynamics. Silver demand there hit record levels in 2025, partly because gold at $4,100 per ounce priced out middle-class buyers who shifted to silver as an affordable store of value. This wasn't happening in 1980 or 2011. The global physical market wasn't this fragmented. Premiums weren't this persistent. And here's where it gets interesting. The margin hike on December 26th was positioned as risk management. But risk management for whom? If you're managing risk for the exchange, for the clearing members, for the banks that backstop this system, what are you actually worried about? You're worried about a situation where futures contract holders demand physical delivery in volumes that exceed available inventory. You're worried about a squeeze, because if that happens, if more contracts stand for delivery than metal exists to deliver, the exchange has 2 options. Option 1, find metal somewhere, borrow it, ship it from London, pull it from eligible stocks, whatever it takes to make delivery. Option 2, force cash settlement, pay out the dollar value instead of delivering physical metal. Option 2 destroys credibility. It tells the world that paper silver isn't really backed by physical, that futures are just bets on price, not claims on actual metal. COMEX doesn't want option 2. Nobody does. So what do you do instead? You make it more expensive to hold leveraged long positions. You raise margins. You reduce open interest. You force some longs to liquidate before delivery month arrives. That's what the December 26th margin hike looks like from a structural perspective. Not manipulation exactly, more like self-preservation. But here's the problem with that strategy in December 2025. The people taking delivery aren't speculators on margin. They're industrial users. They're sovereign wealth entities. They're investors who specifically want physical metal, not cash. You can't margin call someone who's paying cash and demanding delivery. And that's the dynamic that makes this different from 1980 and 2011. In 1980, margin hikes crushed the hunts because they were massively leveraged. When margin requirements went to 100%, they couldn't post collateral. They had to sell. The price collapsed. In 2011, margin hikes crushed retail speculators who were leveraged through ETFs, futures, and options. Same mechanism. Remove leverage, force selling, price collapses. But in December 2025, a significant portion of demand isn't leveraged. It's cash buyers taking physical delivery. Industrial users locking in supply. Investors moving from paper to metal. You can raise margins all you want. If physical demand continues, if people keep standing for delivery, if inventories keep draining, price doesn't collapse. It dislocates. You get backwardation. That's when nearby futures contracts trade below spot prices. It's a signal of immediate physical scarcity. Normally, futures trade at a premium to spot because of storage costs and time value. When that flips, it means people need metal now, not later. Silver was in backwardation for much of late 2025, spot trading above futures. That's not speculative excess, that's shortage. So let's talk about what happens next, because there are two very different paths forward, and which one we take depends on a question nobody can answer with certainty. Does the physical shortage persist? Path 1, it doesn't persist. Industrial demand moderates, Chinese buyers pull back, Indian demand softens. Somehow, supply catches up, inventories stabilize. In that scenario, the margin hike works exactly like 1980 and 2011. Leverage longs liquidate. Price falls 20, 30, maybe 40%. Silver goes back to $35 or $40. The rally is over. Everyone who bought at 55 or 60 loses. Path 2, the physical shortage persists or worsens. Industrial demand doesn't moderate because solar installations and EV production are policy-driven, not price-sensitive. Chinese buyers keep pulling metal. Indian demand stays strong. Inventories keep draining. In that scenario, the margin hike doesn't work. Leveraged longs liquidate, sure, but physical buyers step in. They're not borrowing, they're paying cash. The price dips briefly, then recovers. Maybe it consolidates, maybe it chops around, but it doesn't collapse. And then, if delivery demands continue into January, February, March 2026, COMEX faces the nightmare scenario. Not enough metal to deliver. That's when things get really interesting. Because at that point, exchanges have to decide, do we change settlement rules? Do we force cash settlement? Do we impose position limits so strict that futures trading becomes meaningless? Any of those options damages credibility. And once credibility is damaged, capital flees. Paper silver becomes untrusted. Physical premiums explode. You could see a world where COMEX silver trades at $45, while physical coins and bars sell for $70, a 50% premium. That's not impossible. It's happened in other commodities during severe dislocations. So which path are we on? I don't know. Nobody does. The data is mixed. On one hand, silver fell from $64 in mid-December to about $58 by late December after the margin hike was announced. That's a 9% pullback, consistent with forced liquidation from leveraged longs. On the other hand, physical demand indicators haven't softened. Shanghai inventories hit decade lows in December. London inventories are near record lows. Lease rates, the cost of borrowing silver, spiked above 30% annualized in late 2025. That's panic-level borrowing cost. When borrowing costs are that high, it means people are desperate for physical metal. They'll pay 30% annual interest just to get it for a few months. That doesn't happen in a market with adequate supply. So the question becomes this. Is December 2025 the moment where COMEX successfully kills another silver rally through margin manipulation? Or is it the moment where the physical market finally overwhelms the paper market and the entire pricing mechanism breaks? Here's what I'm watching over the next 90 days. First, COMEX registered inventory. If it keeps draining below 100 million ounces, below 80 million, that's a red flag. The exchange is running out of deliverable metal. Second, delivery requests for January and March 2026 contracts. If open interest stays high and people keep standing for delivery instead of rolling contracts or taking cash, that's pressure building. Third, Shanghai and London premiums. If physical markets keep trading above COMEX, if that spread widens instead of narrows, it confirms the disconnect between paper price and physical reality. Fourth, lease rates. If they stay elevated or spike again, it means shortage conditions persist. And fifth, margin requirements. If CME raises them again in January or February, it's a sign they're worried. One hike could be routine. 2 or 3 in quick succession like 2011 means panic. The trade here is not about predicting whether silver goes to $100 or crashes to 30. The trade is about understanding that we're in a regime where physical supply dynamics might finally matter more than paper market leverage. For 40 years, since 1980, COMEX has controlled silver price through leverage. When they wanted price down, they raised margins. When they wanted stability, they kept margins steady. The paper market dictated the physical market. But if we're entering a world where industrial demand is structural, where supply deficits are persistent, where sovereign buyers and manufacturers take delivery regardless of price, then the paper market loses control. And when the paper market loses control, price discovery moves to the physical market. And physical markets are smaller, less liquid, and far more volatile. That's the world Silver Rule 7.0 is trying to prevent. Because the exchange knows that if physical shortage becomes undeniable, if COMEX can't deliver metal, the credibility of the entire futures market collapses. Not just silver, the whole commodity complex. So whether you're long silver, short silver, or just watching from the sidelines, the next 90 days matter. If silver consolidates around $55 to $60, holds physical demand, and doesn't collapse, that's a sign the margin hike failed to break the rally. If silver drops to 40 or below, stays there for months, and physical premiums narrow, that's a sign the old playbook still works. One of those scenarios keeps the system intact. The other breaks it. And here's the uncomfortable truth. Nobody at COMEX, nobody at the CME, nobody in the banking system that clears these trades wants the system to break. Which means if physical shortage is real, if inventories keep draining, if delivery demands keep coming, you're going to see more margin hikes, more restrictions, more rule changes. Because the alternative is admitting that paper promises outnumber physical metal. And that admission destroys trust in the entire futures market structure. This isn't about good guys versus bad guys. It's not about manipulation versus free markets. It's about a system that was built for price speculation, trying to function in a world where physical scarcity is real. And when those two things collide, something breaks. Either the price breaks, like 1980 and 2011, or the system breaks like we've never seen before. The next 90 days tell us which one. Now, if you want to understand how to actually position for this kind of market stress, how to hold silver in ways that can't be margined out or manipulated away, I've got something you need to see. There's another video on this channel about the 3 silver positions that protected wealth through every modern crisis. Not speculation, not trading. Actual protection that worked when systems were under pressure. It covers what worked in 1980, what worked in 2008, what worked in 2020, and why those same structures matter even more heading into 2026. Click the link, watch that next. Because understanding the pattern is useful. Knowing how to position for it is what actually matters. The window to prepare isn't after the system breaks, it's before.